Welcome to Ben's Market Insights. It's the 11th of November. Lest we forget, it's Remembrance Day, and we are forever grateful to the fallen heroes for all the freedoms that we have today. Let's get to markets. Looks like the Dems have folded. Unemployment figures that came out last week from the private consultancy group Challenger are not particularly encouraging for the economy, but could be encouraging for the continued rate reduction strategy that the Fed has employed and may well result in a December reduction. And then let's get to markets pretty quickly after that, because I want to talk about the idea that equities will continue to outperform cash quite significantly in terms of the returns profile that they generate. And we'll talk about return on invested capital, ROIC, about the weighted average cost of capital, the WACC, and the margins that go with that. So let's jump straight into the fact that as of last night, the shutdown of the government in the US looks like it's over. The Dems have essentially folded, whatever way they want to put that to the public. The Republicans have really not moved away. And I don't want to make this a political comment, but the reality is that the medical premium costs that was the center of the discussion remain as they are. The Republicans have promised that there will be in December a discussion and a potential vote on that. They've not really proven to be particularly trustworthy in the past, so I'm not convinced that the Democrats have got a particularly good deal out of this at a time when the polls were really supporting the Democrats' position on the healthcare issues, and they were seeing that the economic implication of the shutdowns beginning to hurt, and hurt mostly the Republicans. So at this point where the Democrats could really have pushed the point home, they've retreated. And I think that that actually could well have an impact on the midterms as well, on the basis that ultimately they appear weak. The Republicans have remained steadfast. Not that I necessarily believe that they have a particularly good wicket to play, because ultimately healthcare costs will soar, and that is not good for the economy. So we've also had the Challenger consultancy numbers that came out, which suggested that layoffs are threefold those of September at 153,000. That is not good reading, and probably one of the worst numbers we've seen in almost a decade, withstanding the COVID period. And that, I think, is going to, personally, I think it's going to encourage the Fed to come off its hawkish stool and head back towards thinking about a rate reduction in December. Now, that, I think, is continuing to provide liquidity momentum for the markets. Clearly, we had a strong day yesterday on the back of the assumption that rates will be tailwind for the market. Now, let's jump into why we think that the equity market is going to continue to outperform, certainly maybe with more volatility, but certainly on an upward trajectory. First and foremost, let's look at the type of returns an investor will get when they put, a private investor will get when they put their money with their IFA in the UK or with their IRA in the US, with mutual funds generally speaking, or private accounts generally speaking that take on balanced portfolios. According to asset risk consultants, ARC, the average return that a private account should expect is 6.1%. Now, let's think about what the return on invested capital, so this is the money that the cash that companies generate that they then reinvest into capital expenditures and R&D for the S&P 500 overall. That has consistently run at something like 8 to 10%. So straight away, a slightly better return. Clearly within that has been increasingly skewed by the tech sector. Now, the Mag 7 account for some 25% of the S&P 500 index. And so we know that this leadership carries with it significantly better returns. So when we look at sector-based return on invested capital, We're looking at the financials at 1 to 3%. Autos are actually running at negative. Commodities are somewhere between 6 and 8%. Food at 7 to 9%. Non-discretionary purchases at up to 10%. General tech, 15 to 17%. So you can see we're rising up that ladder of returns. And the oil and gas sector at some 7 to 8%. At their height, the various sectors that did incredibly well in the past, be they the Nifty 50 in the 70s or the oil and gas sector, it kind of peaked out at return on invested capital around the mid-teens. Today, these Mag 7s, the leaders of the marketplace, are running at an average of 28 to 30% return on invested capital. We'll come back to that in a moment. Let's think about also the kind of EBITDA margins that the market is generating, which allows the cash flow to be generated. Broad market EBITDA margins are somewhere between 8 to 12%. The weighted average cost of capital, so this is the attributed cost of being able to raise the capital for different sectors across the market, is running at about 8.5%. And the things that are attributed and depend on the WACC includes the risk associated with investing in that sector, the capital structure of any individual company, i.e., are they highly indebted? Are they cash generative? Do they have cash sitting on the balance sheet? And of course, the broader interest rate environment, are interest rates moving higher or lower? That will clearly have an impact on the WACC of a company. So heading back into this idea that there is overspend on AI, and we know that to date, the Mag 7 in total, both CapEx, R&D have announced some $650 billion worth of CapEx for 25 in terms of their announcements. And by the way, some 15% of data center spend today is really AI related. So I would argue that actually we're on the foothills of the potential AI spend that's coming around the corner. So relatively early stages still. So when we look at the Mag 7, so Meta, Microsoft, Google, Amazon, Tesla, Nvidia, and Apple, and we look at the return on invested capital, as I said earlier, the average is around the 28 to 30%. There are outliers like Tesla at the low end at 6.5%, and at the higher end we'll get something like an Nvidia at 110%, but clearly that's in the relatively near term. The average EBITDA margin for this group is at 40.6%. Compare that to the much lower figures for the broader market. And then when we look at the kind of the higher end of that margin play, Nvidia sitting at some 60% and Tesla at 13.8%. Let's also think about what the actual cost of debt for some of these names are. So we know that Meta has gone from a net cash position on the balance sheet to a net debt position on the balance sheet in terms of their CapEx spend. And they now have, despite an annual free cash flow generation of some $45 billion. And when you look at what their bonds currently yielding, on the short end, i.e. the 2-year, it's at 3.75%, so just under 4%. And on the higher end, so the 10-year bonds are yielding about just under 5%. So pretty much in line, slightly above, some 60, 70 basis points above the Treasury 2-year and the Treasury 10-year for US Treasuries that are out there. The WACC for Meta, if you look at different analysts, is coming through at some 5 to 7%. So in my view, even if we feel that the AI play is way over ingested in terms of capital thrown at it, and that these historic or recent historic return on invested capital numbers for these companies is way too high, and let's even halve them, they're still above the broad market level. They're still more than double the sort of returns that an average private client would be expecting. But I would argue actually that those that are spending the biggest amount of CapEx are actually the beneficiaries in the long term. And what AI is bringing to the table in terms of the productivity levels to clients of these Mag 7 companies potentially realizes even higher margins. The reality is that the general interest rate environment is providing for interest rates to come down. That in itself reduces the WACC, the weighted average cost of capital assumptions for these businesses. So we are in an environment today where the Mag 7, which is 25% of the S&P 500 index, is generating a return on invested capital around 30%, with margins averaging at almost 40 to 42%, a weighted average cost of capital at some 7.5 to 8% and potentially falling. These are significantly better margins and better returns than any individual investor can expect from their IFA or IRA over the long term. And that is why I think that equities continue to provide way better returns than an average balanced portfolio of bonds and equities on a global basis. So this concentration, I think, is actually will prove to be over the next 2 to 5 years a boom for the markets, for equity markets, given these very high return on invested capital. Have a great week, and we'll see you next week.